Hey traders, Lance Beggs here from YourTradingCoach.com. In previous videos I mentioned that my analysis involves monitoring price action in order to gain an insight into the short-term sentiment of the market, determining who is in control at that time, the bulls or the bears, and assessing how they're likely to respond to changes in the market. I thought today I'd prepare a quick video to give you an overview of how I analyse price. Those of you who know me know that I'm a great fan of candlestick charting. However, price analysis is much more than just watching for your favourite candlestick patterns. Too many people just teach the candlestick patterns, which is fine, but in my opinion, there's some essential analysis missing that an astute trader needs to consider before they look at price action and respond to the candlestick or price bar patterns. Let's have a look at what I mean. Price analysis for me is essentially a top-down approach, working from the macro level of market structure, so we analyse the big picture first, then down to the current trend within that structure, and only then do we look at the current price, whether through candlestick analysis or whatever other method works for you. So I basically start off with a wide view of the market and then drill down to the detail in the current price bar or pattern. I prefer to do this over two time frames. The market structure is defined primarily on a higher time frame. For me as a day trader, that's the 1 hour charts. Of course, if you trade differently to me, then that can be any other time period you wish. Just make it higher than the time frame you trade on. I recommend by at least a factor of 4. Then on the shorter time frame, what I call the trading time frame, I refine the market structure a little further, analyse the movement and strength of the trend, and then assess the bullish or bearish sentiment based on the current price patterns. For me, the trading time frame is anywhere from 1 minute to 5 minute charts, depending on the market, its volatility, and how well the price is flowing. So what do I mean by market structure, trend analysis, and price analysis? Firstly, let's look at market structure. The higher time frame chart is opened and any areas of major support or resistance are identified and clearly marked on the chart. Support and resistance for me are areas of past price congestion, swing highs or lows, or gaps. This doesn't include any guessing at future support or resistance via the use of pivot points or Fibonacci levels. I'm not a fan of either of those analysis techniques. Of course, if they work for you, that's excellent. Keep using them. My expectation when I trade is that there is a higher probability of price stalling or reversing at these areas of major support or resistance. I then narrow my focus to the shorter trading time frame and add to the market structure framework by identifying areas of minor support or resistance. Typically we look at the current trend first, but you may at times need to look back beyond the current trend to previous market action to find applicable areas of minor support or resistance. Once again, these come from areas of congestion, swing highs or lows, or gaps. That is, areas which are proven to stall price movement or reverse price direction. My expectation with minor support is for it to hold in an uptrend, and for minor resistance to hold in a downtrend. That's it for the market structure, simply identifying a support and resistance framework within which price moves. Simple. Having defined our market structure, or a framework within which price will move, we now focus our attention on the current trend. This occurs, as does all further analysis, on the trading time frame. I conduct analysis on the trend to identify its strength. Is the trend moving strongly, in which case we can anticipate it being more likely to break through the next support or resistance level? Or is it weakening, in which case we have a greater probability of the support or resistance level forming a barrier to further price movement? We determine the strength of the trend by looking at its proximity to the support and resistance barriers within the framework, and also gain clues from changes in either momentum or in volatility. Is the current price swing faster or slower than preceding swings within that trend? Is the current price swing speeding up or slowing down? Is the volatility changing? Is the average range of the price bars increasing or decreasing? These sort of questions regarding changes of volatility and momentum can give you clues to the changing strength of the trend and the likelihood of a reversal or a continuation through an area of support or resistance. If you want to get experienced at this, it takes time. Review price charts over and over, identifying how changes of momentum and volatility precede either a continuation or reversal of the trend at a point of support or resistance. Having gained an appreciation of the strength of the trend and its location within the support and resistance framework, only then finally do I concern myself with the current price action to determine the bullish or bearish sentiment, or more particularly a potential for change of sentiment through candlestick analysis. Let's look at a couple of examples. Instead of entering short on a candlestick shooting star reversal pattern. Just because it matches the shooting star diagram in my book on candlestick patterns, I'm entering short because price just meandered slowly up to a major resistance level. The current price swing has clearly less momentum than the previous upswing or downswing, and the price bar range is clearly narrowing. This gives a reduced likelihood of the commitment required from the bulls to break through the area of increased supply. The shooting star pattern provides evidence of clear rejection of prices at that resistance level. This provides me with a lower risk or high probability trade in the short direction. In this example, instead of entering long on the Harami cross reversal pattern just because it matches the Harami cross in my book on candlestick patterns, I'm entering long because a strong and accelerating move downward on greatly increased volume extended the price rapidly to a great distance below its moving average, right into an area of major support. This is an area where I expect increased demand is likely to be sufficient to absorb and overcome the force of the bears, who have possibly spent all their energy on the climactic move downwards. This is an area where I expect price to find support. And the Harami cross clearly shows price halting from the rapid move down and allows me an opportunity to enter a low-risk trade close to an area of major price support. Seriously, the end result might be the same, but at least I've entered based on a reasonable assessment of the price action in order to maximise the potential for a lower risk or higher probability trade. Over a lifetime of trading, I expect this approach will produce more favourable results than just entering because the pattern matched one I'd memorised from a book. Okay, a bit of a summary, and I know this is a bit of repetition for those familiar with my work, but don't just blindly take your entry triggers. Think about where they occur within the bigger picture structure of the market. The market structure defines where you trade. The trigger, whether a candlestick pattern or some other form of entry trigger, tells you when to get in, only when you've first met the requirements of the market structure rule. Think about where the current price movement is within a framework of support and resistance. Think about the changing strength of the current trend or price swing as it approaches the area of support or resistance. Watch for signs of strength or weakness in the trend through clues evident in changes of momentum and volatility. And don't forget, guys, always use stops because there's no guarantees. This is a game of probabilities. I'm Lance Beggs from YourTradingCoach.com, wishing you happy trading. Cheers.